Exchange-traded funds, ETFs, have emerged as a dominant force in the investment world since their introduction in the early 1990s. With an eye-watering $7.2 trillion in assets under management, ETFs have surpassed mutual funds as a preferred investment vehicle for retail investors. This meteoric rise can be attributed to several key factors, including tax efficiency. ETFs offer a significant advantage over mutual funds in terms of tax efficiency. When asset managers actively buy and sell securities within mutual funds, these transactions can trigger capital gains taxes for fund investors. On the other hand, ETFs are structured in a way that minimizes capital gains distributions, making them more tax-friendly for investors. This is particularly beneficial for those holding ETFs in taxable accounts. Lower costs. ETFs generally carry lower fees compared to mutual funds, making them more appealing to cost-conscious investors. On average, ETFs charge an asset-weighted annual fee of 0.37%, while mutual funds command a higher fee of 0.45%. This difference in fees can translate into substantial savings over time. Global expansion. ETFs have experienced remarkable growth beyond the U.S. borders. In 2022, total assets outside the U.S. market reached $2.7 trillion, showcasing their global appeal. This trend is expected to continue, with PwC predicting that global ETF assets could exceed $20 trillion by 2026. Growing supply and demand. ETF asset managers have responded to the surging demand by launching a plethora of new funds. In 2022, there were 419 U.S. ETF fund inceptions, compared to 197 mutual funds. This reflects the growing preference for ETFs among investors. While ETFs have made significant strides, mutual funds still hold a commanding 70% market share, with $17 trillion in assets. Mutual funds are deeply entrenched in 401k plans, a significant portion of U.S. savings. However, the growing popularity of ETFs and their inherent tax efficiency and lower costs suggest that their dominance is likely to continue. In the realm of investments, historical data has consistently demonstrated that actively managed mutual funds have struggled to outperform the overall market. While some actively managed funds may experience periods of outperformance, these gains are often fleeting and difficult to replicate over time. In contrast, index funds and ETFs, which track broad market indexes, have generally exhibited superior long-term performance compared to actively managed funds. This lack of consistent outperformance from actively managed funds stems from several factors. First, the stock market is often efficient, meaning that prices reflect all available information, making it challenging for active managers to consistently identify mispriced securities. Second, the costs associated with active management, such as portfolio turnover and fees, can erode returns over time. Third, the inherent difficulty of beating the market, combined with the costs of active management, makes index funds and ETFs a more attractive choice for many investors. In light of these considerations, it is advisable for investors to carefully evaluate the performance of actively managed funds before making investment decisions. While actively managed funds may offer the potential for outperformance, the historical data suggests that index funds and ETFs offer a more stable and cost-effective approach to investing. ETFs are just a no-brainer. Thanks for watching.